So how does a short put actually work? I think it's important we all understand this if we don't already. So with a short put, our assumption is that the stock price will go up. It's kind of a theoretical substitution for buying stock. So same assumption as buying stock, we want the stock price to go up. Now if we just bought stock, and we're going to use a simple example here, let's just say we bought stock and the stock price was $100. Well, when do we make money when we buy stock? Well, only when the stock goes up, right? So in actuality, it's a 50-50 game when you buy stock. There's a 50% chance the stock's going to go up and a 50% chance the stock's going to go down. No matter what you think you know about stock, maybe a year from now you might think it's going to go up, that's great, but as of today, if I buy stock, it's an absolute 50-50 bet, simply a coin toss on whether I make money on that trade or not. Now a short put's going to change that up a bit. So how does a short put work? So let's go with a simple example again. We're sticking with the same stock, and the stock price at the time we decide to make this short put trade is $100. And what we're going to do is we're going to say I'm going to sell the $90 put strike. And first off, I'm going to say that we're going to sell it for $5. So what does that mean? Well, that means is depending on how long I have this option for, let's just use a simple example again, say there's 30 days until this option expires. 30 days from now, as long as the stock price is above my strike price, which is $90, I will get to keep the entire credit I sold it for, which is the $5. And as you know, with options, because they're leveraged, $5 is actually $500. So when I made this trade 30 days ago, let's say the stock price was 100, I sold the 90 strike, and as long as it stays above 90 30 days later, I collect $5 or $500. It obviously becomes apparent right then and there that there's got to be a better than 50-50 shot of me making money on this trade, because the stock was $100 when I made this trade and I'm way down at 90. So if stock's 50-50, obviously all this extra cushion here gives me a much better chance that my odds of winning on this trade are higher than 50-50. So that's important step number one. As long as I stay above my strike price expiration, I keep all the credit I sold it for. And number two is I've just turned this trade into a much higher probability trade, because the stock was 100 when I did this. So there's got to be a better chance that I make money if I sold the 90 strikes. So this is a better than 50-50 trade. Important to understand that. But there's an added benefit of selling puts. So let's show you what that is. Again, we sell it for $5. And whenever you sell any option, the most you can make is what you sell it for. And as we've seen here, as long as the stock price closes at 90 or above after our, let's say, 30-day window, we're going to keep all $5, or the maximum profit on the sold put. But what happens if it goes below $90 at expiration? And don't worry, we're going to show you how this all works down the line. This is just kind of laying it out for you. We'll explain it in detail coming up. But when I sell this put, what happens is my cost basis on the stock actually goes all the way down to 85. So what that means is, although 90 and above is max profit, anywhere in this neighborhood between 85 and 90, I still end up making money. It's actually a one-for-one basis. What I mean by that is, if the stock were to close for $89, since my cost basis is actually 85, all we're going to do is subtract 85, our cost basis on this, and you'll see that we end up with an actual $4 or $400 winner. Even if the stock closes below 90, all the way to 89, we make $4 profit. So hopefully you can see it makes sense that as we go, we lose $1 each time. 88 would be a $3 profit, 87 2, 86 1, all the way down to 85, which is the break-even price where we'll make no money. We won't lose money, we won't make money. The other thing is, if the stock were to just go way down, let's say something crazy happens and the stock drops $30 all the way down to $70 at expiration. What happens then? Well, if the stock is $70 and our cost basis is $85, we will be down $15. That sounds horrible until you remember that if you just bought stock at $100, you would be out $30 if it was 70. Here you're out half as much. So the benefits of short puts are two. you have a much, much higher chance of making money because anywhere in this area is profit for you. Obviously, the stocks here, when you make the trade, this gives you a huge window of opportunity to make some money on the trade, which is why it's a much greater than 50-50 chance of making money when you sell puts. And on the downside, if things go horribly wrong, we lower our cost basis, which means if the stock were to tank, yes, we lose money, but we're going to lose a lot less than if we just bought the stock by itself. Hopefully that illustration kind of shows you the benefits of short puts.